Welcome. Today is July 21st. I'm Jeff Huge, Chief Investment Officer at JWH Investment Partners and editor of Alpha Insights. And this is your Daily Five. So today we've entitled this episode Position Sizing. The market's been volatile of late, and we think that there's a bullish outcome to this volatility, but just to be on the safe side, we want to talk a little bit about position sizing. But before we do, let's take a look at the market. So our first chart of the day is a look at the S&P 500 with a couple of different overlays on top of it. Our viewers will know in the past we've shown a slide similar to this where we're actually projecting a fairly significant upside from current levels to around, we've been saying 4,600 on the S&P 500, but we've given ourselves a bit of a range here. About 4,550 to 4,650 is kind of our working hypothesis. And the way that we get there is using a measured move calculation that basically takes the depth of the base that was achieved in the March sell-off last year and projects it above the prior high, which was in February of 2020. And that projection actually gets us to about 4,600. We've also used an equal swings move off of the first up leg, which took us into the September 2nd high last year. And we're projecting that off the October 30th low to come up with a similar target. So we've got a couple of different measured calculations that get us into the same ballpark. But more importantly, we are actually overlaying an Elliott wave count on the S&P 500 that has a fairly direct sort of upside expectation going forward. So if Monday's low was minor wave 4 as we've identified it in the chart, then that puts the index at the forefront of minor wave 5, of intermediate wave 5, of primary wave 5, and potentially cycle wave 5. So this could be a very big yet terminal move to the upside. This should actually be the final leg before a major correction of at least cycle degree, in our opinion, takes place. But we're not going to worry about that just yet. We want to focus on the immediate upside potential that exists in the market. We think that upside could get us to around 4,600 on the S&P. Our line in the sand in terms of support is the June low. That's 4164. We're calling that key support. That coincides with the 20-week moving average, which is like a 100-day moving average. So far, we're holding those lows quite nicely. We're actually holding above the 10-week moving average, which is more like the 50-day. And the market has bounced pretty aggressively off the lows of Monday. So we're anticipating that this is the beginning of wave 5, and that will be confirmed upon a new high, which would require us to trade at above 43.94 basically to confirm it. So that would be our confirmation target at this point. Chart number 2 takes a look at what we're calling the cycle composite. This cycle composite basically looks at an equally weighted representation of 3 different cycles. There's a 1-year seasonal cycle, a 4-year presidential cycle, and a 10-year decennial cycle. And the combination of these cycles overlaid together gives us a pretty good forecast of the directional trend of the S&P 500 index. Now, year to date, the index has been tracking this cycle composite with a very positive correlation of about 90%. So what we've done is we've taken this cycle composite data and we've updated it to include through yesterday's rally. And we've marked it, you are here. We think that we're in the midst of a fairly substantial upside move that will take us to new all-time highs in the market. And again, our target price is 4,600. Now, a lot of people might say that that's too aggressive. 250 S&P points from here might sound like it's, potentially unlikely, but keep in mind that we've just rallied at almost 150 S&P points in the last couple of days. So it's not as unlikely as you might think. It would surprise quite a few bears out there, we believe. And frankly, it would be very consistent with what the market is cyclically expecting at this point. Following that cycle, we think the market could turn down. And so the Cycle Composite actually looks for the market to turn down sharply in mid to late August and through September into October. And so that would be seasonally typical. Would also be consistent with our Elliott wave count. So what is an investor to do at this point? How do we choose what to buy? Well, that's what we're going to look at in chart number 3. So given the circumstances today, a very bullish immediate upside potential with a very bearish back half of the year potential beginning in, say, mid-August. We want to be careful about the sort of stocks that we invest in. And so one of the ways that I choose to kind of identify what stocks to buy is to actually run a screen looking at stocks that are very, very strong, have high relative strength, they're making new 52-week highs. And so I thought I'd just walk through the process of that and the results, frankly, and just give an example of how our viewers might use some of the tools available on the StockCharts website to identify high probability winners in the stock market. So if you were to go to your advanced scan workbench on StockCharts.com, you could very easily begin a scan for stocks in the S&P 500 that are making new 52-week highs. So the results we're looking at in chart number 3 actually are from yesterday. And the process is simply just, go to the pre-defined scans dropdown in that menu and choose new 52-week high, and then add S&P 500 index from the indexes and ETF dropdown, and then click the green run scan button, and that will populate the results. So we have 11 new 52-week highs in the S&P yesterday. And what we want to do is we want to take a look at each one of these stocks individually and try and identify patterns or ranges that could potentially be reversing to the upside. And so rather than spend our time looking at 11 different stocks to find the 1 or 2 that make sense, I'll take you right to that result in chart number 4. We've done the work here, and we've actually identified one of the names that is a standout winner amongst these in terms of its potential based on pattern, price, and price action, that being momentum. So Tuesday's new all-time high and bullish inflection above resistance at 225 actually resolved a classic pattern base formation of the head and shoulders variety in Dollar General stock, symbol DG. And so what we're looking at here is a 3-year weekly chart. Actually, it's about a 2-year weekly chart of Dollar General. And the breakout of this inverted head and shoulders lateral consolidation or base formation has a high probability profit target that can be measured using traditional measured move sort of calculation, where we take the depth of the base and project it above the neckline. And some might actually take the depth of the base and project it off the prior high. In either case, we get a fairly substantial upside move. And so if the breakout is sustained, it actually projects up to approximately 275 in a range of around 265 to 275 for a potential 20% gain here. Now, we would advocate using an initial stop loss provision at about 215. That would be below the 10-week moving average. And if the stock were to reverse back below what was resistance and is now support, and further were to sustainably break below the 10-week exponential moving average, we would probably have to call this trade as a failed breakout, and we'd move to the sidelines here. So if we do get stopped out, it's worth the risk for us because the upside potential is about 4 times the downside risk that we're taking. That's a very attractive 4-to-1 positive risk skew. And that's what we're looking for. We're looking for opportunities where the risk reward ratio is in our favor, and this is on a 4-to-1 basis, which makes it a very attractive trade. So let's get to position sizing. Chart number 5 takes a look at exactly how many shares an investor might consider owning under the circumstances that we've described here. So, we really feel like investors need to define their risk parameters long before they even start looking for stocks. And so we've created a template here, which we can make available to our viewers at your discretion. If you'd like a copy of this template, I will send it to you for free. You can go to my website, jwhinvestment.com, send me an email and request this position size calculator. I'll send you the spreadsheet. And it's pre-populated, pre-programmed, and it does the job. What we're really looking at here is a hypothetical risk-based capital account of $100,000. And we're using an entry price, which was yesterday's close of $226.88. Now, what we like to do is establish our trade MAR. That is the maximum adverse excursion or loss that we're willing to accept for any given position. And for me, that's typically about 50 basis points. So I'm willing to risk 0.5% of my capital on any given trade, especially one of this nature that has, 4-to-1 upside risk skew. And so what we've done basically is we've used the average true range to identify a stop loss provision that basically optimizes that trade MAR so that we'll get stopped out once the trade loses $500. We're out of the trade and we'll move on to the next. And that's about the 215 mark, 215.45 to be exact. We usually like to use round numbers, and we like to use numbers that are below obvious technical levels that might actually get stopped because there's stop loss hunters out there and these algorithms that are looking to shake people out of their positions to create liquidity. And so we don't want to get shaken out. So we're a little bit below the market here in terms of where we think that would occur. Our max net loss would be about $11.43 on the trade, call it $12, a little over 5%. So 50 basis points of our hypothetical $100,000 account. Our upside potential is about 48 points. That's a little more than 20%, as we discussed, giving us a positive risk skew of 4-to-1. And our portfolio weighting would be under 10%. So the number of shares, basically just using the difference between our entry price and our stop loss price, trying to optimize that $500 loss position gets us to a maximum of 44 shares. So under these conditions, 44 shares of DG would be the maximum position that we would want to take in the stock in order to minimize our risk to $500, our maximum acceptable adverse excursion. So in a nutshell, that's how you manage position size to control your risk. And by the way, position size is about the only variable that you have absolute control over. So keep that in mind when you're trying to manage risk in your account. If you'd like to get in touch with me in the future, the next slide actually has some contact information. Again, my website is jwhinvestment.com. I'm also on Twitter at alpha_insights. You can find me on the Trade Exchange under Alpha Insights or LinkedIn under Jeffrey W. Huge CMT, or just send me an email at jhuge@jwhinvestment.com. I'd be happy to share this position size calculator with all of our viewers today. With that, good luck trading, and thank you for watching.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.